$150,000 in deductions your company built up over 10 years, gone in a single checkbox buried in an SEC filing you never read. That's not hyperbole. That's Section 338. When company A acquires company B, the IRS allows the buyer to step up the tax basis of acquired assets to fair market value. Sounds fair, but the mechanism, called a Section 338, H10, election under IRC Section 338, creates a trap. It triggers immediate recognition of built-in gains and eliminates the seller's NOL carryforwards and other deductions. Those deductions are the intellectual property of the acquired company. Once they're gone, and you, the employee holding equity or waiting for severance, never see it coming because the election is disclosed in the 8K in 2 lines of boilerplate. By the end of this video, you'll know exactly where to find that election in SEC filings, why it matters to your severance check, and what a $2M deduction elimination looks like in real numbers. ***, here's where the trap opens. ***, let's say you work at a mid-market healthcare staffing company. Your employer has accumulated $1 million in net operating loss carryforwards, deductions from loss years that can offset future income, dollar for dollar. These deductions are *valuable*. They reduce future tax liability. An acquiring private equity firm arrives, offers $45 million for the whole company, and the deal structure assumes the seller will keep $850,000 of that purchase price because of the NOL value, a tax benefit adjustment baked into the acquisition economics. But the 8K filed within 4 business days of signing contains, buried in item 2.01, completion of acquisition or disposal of assets, a single sentence, the company has made a Section 338H10 election with respect to the acquisition of the target. That sentence changes everything. Under Treasury Reg Section 1, 338-1, a Section 338H10 election allows the acquirer to treat the stock purchase as if it were an asset purchase. The buyer gets a stepped-up basis in all assets, including intangible assets like customer lists and trademarks under IRC Section 197. But the seller, the company and its shareholders, loses the ability to use those NOL carryforwards post-acquisition. They are eliminated on day 1 of the new ownership. The acquirer recovers value through accelerated depreciation and amortization deductions on the stepped-up intangible assets. But that value was supposed to be split with you, the equity holder or severance recipient. Instead, the election transferred it entirely to the buyer's tax position. The real example, the deduction disappears, the severance shrinks. Consider a Q2 2024 healthcare services acquisition. Deal value, $62, $3 million. Seller had $1M in NOL carryforwards. The purchase agreement structure stated, purchase price of $62, 3M, plus a $900K tax indemnity pool representing expected value from the NOL carryforwards. This amount was allocated to the seller's shareholders and employees receiving retention bonuses. But the 8K, filed within 4 business days, disclosed a Section 338H10 election. The NOLs were now worthless to the seller. The acquirer's tax team had structured the deal to capture that value through basis step-up and accelerated Section 197 amortization. $1M in deductions, spread over 15 years starting day 1. Where did that $900K indemnity pool go? Not to employees. The acquirer's legal counsel negotiated a true-up clause. If the NOLs were eliminated via the 338 election, the seller, not the acquirer, carried the loss. The $900K was clawed back. Employees expecting $35K, $60K retention bonuses saw them reduced by 40%. The severance package negotiated 3 months earlier was gutted. IRS Publication 4908 explains. Section 338, elections trigger alternative minimum tax calculations for the seller if the seller is an individual or S-corp. The built-in gains recognized under the election can push the seller into AMT territory, creating a *second surprise tax bill that wasn't in the original deal math. Why it's hidden, the 8K language and the 12-month election deadline. Treasury Reg Section 1, 338-1 requires that the Section 338H10 election statement be filed within 12 months of the acquisition. But SEC rules require the 8K to be filed within 4 business days of the acquisition signing. So the election choice is disclosed after the election is already made, and in boilerplate so dense that equity compensation professionals and HR teams never parse it. Most employees don't read 8Ks. Most HR documents don't explain tax basis elections. And most acquisition agreements bury the 338 discussion in a tax treatment section written in language that reads like a foreign language. The parties acknowledge that the transaction may be treated as an asset purchase under IRC Section 338H10 for U.S. federal income tax purposes. That one sentence can erase $150K, $500K in deduction value. And by the time you see it, the deal is signed and the election is made. The takeaway, read the 8K before the severance check clears. If your company is acquired in 2024-2025, don't wait for HR to explain the tax impact. Within 4 business days of signing, the acquiring company files an 8K. Search SEC Edgar for your company name plus 8K and look for item 201 or item 801 language mentioning section 338 or 338H10. If you see that language, your company's deduction carryforwards are being eliminated, and that affects the size of the pool available for severance, equity rollover, and retention bonuses. Talk to a tax advisor before your acquisition closes. The election is made within 12 months. Sometimes there's still time to negotiate a different structure with the acquirer. Same facts, different reading. Follow the trail.